Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dom Chu. The global trade war and domestic economic uncertainty has investors looking to diversify their portfolios in both the brand new and tried and true ways. Joining me now are VanEck and Associates CEO Jan Van Eck, as well as Sprott Asset Management CEO Ciampaglia. Thank you both for being here with us on ETF Edge. And Jan, maybe I just want to start with you first. This week, you launched a fund targeting alternative asset managers. And viewers, we should reiterate that this is brand new. It's a fund that has just launched. I guess maybe what we want to talk about first is why alternative asset managers, and how do you find the demand profile right now among investors and investment advisors for a fund that tracks alternative asset managers?
Sure. Well, John, what's happened in the world is that a lot of the financial markets now are not public. They're not visible. The stocks that are private, that are venture-backed, are not trading on the stock market, and they're not going IPO. So there are about 1,200 what's called unicorns, meaning private venture-backed companies worth over $1 billion. So these are companies, they're going to make it. They're profitable, but they're staying private for a super long period of time. SpaceX is probably one of the most famous ones of those. So the people that manage those private equity funds or private growth funds, those money managers are public themselves. So this is a play on that. The other part is the private credit market. So since the financial crisis, the regulators told banks to stop risky lending, right? We want the banks to stop blowing up every 10 years. So a lot of lending to corporate America actually happens privately, offering really attractive yields, 10 or 12%. And that's grown a lot. We actually offer a version of that in our BDC ETF called BizD, and that yields 8.8% today. So anyway, that alternative credit world, so private lending is another part. So it's private stocks, effectively, and private loans or bonds. And the managers of those, everyone's kind of wanting to get into it. People expect allocations to private assets to grow from about 2% of wealth to 10% of wealth. And if that happens, these managers will do really well. And the ETF is GP because the managers are called general partners.
All right, so one of the other things that we want to take a look at is the reason why you are turning towards the managers themselves, when even today there are a slate of certain types of products, exchange traded and whatnot, that actually track some of the private markets themselves. I can think of ETFs, or one ETF in particular right now that has a huge tilt towards the private credit side of things. And we can talk about some of the other asset managers out there who have private equity investments themselves. What exactly is the use case, and how exactly should investors and the maybe investment advisors out there who are thinking about possibly allocating towards this type of space, what types of things should they think about as they look towards investment on an ETF side for the asset managers themselves as a portfolio?
Yeah, that's a great question. I mean, I think you have to believe that this is a secular trend and that these companies will grow at a higher rate than normal money managers, right? So you have normal money managers called mutual fund managers. Mutual fund assets have not grown very much. Then there's ETF managers like ourselves, but there are very few ETF companies, maybe Wisdom Tree, that are public pure plays. But there are enough private asset managers, and these private asset managers have grown from being boutiques to being really large, professional services firms managing almost $500 billion each, the Apollos, the Ares, and they're involved in both the private credit and the private equity side. So they're just super impressive firms. And if you believe that they'll continue to grow and be part of the ecosystem, then you want to have access to that. I will grant you they are a little bit more volatile than the overall market, right? So it's a little of a high beta play on stocks overall is kind of how I think about it. So you have to size it appropriately.
All right, and Jan, one kind of tie up at the end here. When we talk about the liquidity aspect for some of these names, they're not necessarily the most liquid out there in terms of the asset managers that trade out there. I can think of some of the big private equity names that may be different.
Yeah.
But when you take a look at your portfolio, how exactly should investors view the risk profile when it comes to things like how this ETF functions with regard to premium and discount to NAV, given some of the types of names and products that you're talking about right now?
I mean, these are larger cap companies. I mean, somewhere between 10 and several hundred billion. So I don't think liquidity is going to be an issue with this ETF.
All right. Now, interestingly, we're going to move toward another side of the alternative side of things, John, a very specific alternative, and that's uranium as a metal, or metal, I guess, if you want to call it that element. We're having a moment right now, right? Today alone, the Global X Uranium ETF is hitting its highest level since 2014. And this, of course, comes on the back of all of the artificial intelligence hype, as it could be a major power source, nuclear power, with uranium when it comes to data centers and the push towards artificial intelligence. John, the uranium trade, it's one that has gone parabolic just over the course of the last few months. Is this something that is catching your attention?
Yeah, we've been talking about uranium and nuclear energy nonstop for 4 years at Sprott, and we've been incredibly bullish on the segment for a number of very, I think, powerful secular long-term drivers that is moving the world back to nuclear power after largely ignoring it for the previous 30-odd years in most Western countries. And those catalysts, I think, have been very profound. First of all, you had a severe energy crisis in Europe and Asia in 2022 when Russia natural gas supplies got cut off. That was a real wake-up call for a lot of European countries that they did not have energy security. And if you don't have energy security, that will undermine your competitiveness. Businesses will start to shut down and move away to lower cost centers. So it was really about energy security. Obviously, there's been a push around more cleaner technologies. Nuclear energy is zero greenhouse gas emitting, so it ticks the box in terms of low carbon footprint. And it is incredibly energy dense, which means you can store vast amounts of energy in very small amount of space, in sharp contrast to things like oil, natural gas, and coal. So it is really the backbone of the electrical grid. It provides 365, 24/7 baseload power, which is really what you need versus highly variable intermittent energy that renewable sources of energy are providing today. And you're starting to see more and more issues around grid failures. We had one in Spain a couple of weeks ago, which people believe was in part because of excessive solar and wind providing electricity at the grid at one point in time. So there's been a real shift. And with respect to the United States, 2 weeks ago, we had 4 executive orders come from the Trump administration that in our minds is very, very bullish and very, very well thought through in terms of taking a very holistic approach to the entire supply chain around nuclear energy, everything from mining, processing, permitting of new technologies and plants, and really kind of trying to kickstart a lot of these new technologies that the world is clamoring for, particularly the hyperscalers.
John, when I think of uranium, I think of nuclear energy. I grew up in a time when Americans and even more broadly, folks around the world were a little bit more frightened about the aspect of having nuclear power plants. I remember the NIMBY notion, right? Not in my backyard for many of these nuclear power plants. I wonder from an asset manager's standpoint, from a guy who runs money tied to putting portfolios together with some of these types of products and companies, do you feel as though there is actually a fundamental change afoot for us in America, in Canada, in North America more broadly, and then globally, that nuclear power is here to stay and that this is a secular trend for investing in things like not just uranium, but the power companies that go along with them?
Yeah, absolutely. I mean, when I was talking about nuclear energy 4 years ago, the most common questions I would get were, is it a safe technology? What about the spent fuel? And now I think there is so much more understanding and education about this category. And I think it really validates the technology when you have governments around the world, throughout Asia, Europe, and obviously in North America, flipping back to this technology. If you look at a lot of public opinion surveys, they have moved decisively back in favor. And I think it's very clear. It's a reliable a form of energy. It has zero greenhouse gases. It has a very good long-term track record. And it provides a lot of electricity in large scale. And that's right now what the grid is calling for. And it's something that the grid has not had to deal with for the last 20 years. Load growth in the United States has been very nominal. Now you have reshoring of industry. You have AI data centers, which are very electricity intensive, that want to scale up and win this race. And the hyperscalers have figured out that, yes, while renewable energy will be part of that energy solution as well as natural gas, that nuclear in both large scale and small modular reactors, this is the next generation of reactors, are really going to provide a lot of the load growth that the market is looking for in the next 5 to 10 years.
Yeah, just some political context around this, because John touched on a lot of the major things, which is that energy demand in the United States has been flat for decades. And what's really causing that to grow and the need for us to find more power sources are the hyperscalers. So we look at this as AI phase 2, right? We had the semiconductors last year really benefiting, and you need chips first. But now people are like, well, we also need power. And you need reliable power. These data centers can't go down. They can't go down for like a fraction of a second, right? They need to be running all the time. The question was, what are the risks to this trade coming into the year? And no one wanted to see a repeat of alternative energy stocks. And so the negative on it was, it's going to take 5 years to build a nuclear power plant. What's going to happen in the meantime? Investors are not patient, as we know, Dominic, right? And so I said, listen, I think the counter is the Trump administration is going to be so positive this source of energy that you're going to get a drip of positive news and small steps, not just in the US, but elsewhere, that will support these stocks. And you saw that literally today. I think Aklo said that the Air Force is going to use power. And of course, Trump controls federal land, right? So that's not a NIMBY kind of potential risk. It is elsewhere, but not on federal lands. And they're going to leverage that hard to start to show the safety of these newer, smaller technologies.
And John, one final point on this. If we talk about the Trump administration and its views towards trying to promote the energy independence of America, this is also, if you want to look at it from a medium to longer term side of things, this is a type of philosophy or investing construct that needs to survive not just a Trump administration, but future administrations as well, regardless of what their political tilt is going to be. Is this a trade, so to speak, that has enough runway where politics can be out of the issue with regard to why you invest in these types of companies?
Yeah, it's a great question. And I'll start off by saying that energy policy in the US under the previous administration and the current one has really been built and underpinned on energy reality. And that is this growing load growth that many industries are calling for. And so we think that the trend is real. We think this is very similar to what happened in the 1970s and 80s when we experienced an oil crisis. It was a real wake-up call for governments around the world that they needed to invest in this technology. That's when most of the plants were built. What you're seeing right now is life extensions of existing plants. You're seeing plants that were closed restarting. And that's a very powerful signal, because that is the path of least resistance to securing a lot of power with very low greenhouse gas emissions. So we think this trend is long-term and secular and durable. And with the exception of Germany, I think every country around the world has flipped back to nuclear power, which is a very powerful signal.
Yeah, I would underline something that John mentioned, which is it's really bipartisan. What really set the alarms off for us in a positive way was when Democratic governors in California, Michigan, and Delaware kind of were in favor of the extension of some of these plants. And so the Republicans have been for it. So that's really great to see parties working together in the United States. So I think for us, it's really one of the tactical trades, Dominic, that we like the most. I mean, if you look around the world, I think AI is just this multi-year trend that you need to lean into. The other one is completely different, but it's the rise of India. But we see those trades, and we have them in our portfolios.
All right, so let's talk about another perhaps alternative asset that has become way more traditional these days, and that is the kind of gold and silver, the precious metal type trade. We're also seeing some sharper gains as of late in things like gold, silver, platinum, hitting highs over the course of the last couple of weeks as well. And maybe, Jan, I'll turn to you for this one first. When it comes to the gold and silver trade, you run funds that are tied to the companies that actually have to engage in these types of mining activities. Have you seen the type of investor demand out there for some of these gold and first and second derivative plays on gold and silver that are going to have some staying power over the course of the next several quarters and years, despite the fact that we just hit record high, record high, record high?
The short answer is no. I think we're very early innings in this trade, and I'll tell you why. So we started pounding the table in 2023 on Bitcoin and gold. That was a long time ago and much lower prices. But even this year, last year, you saw outflows out of gold bullion ETFs in the United States. And what we've seen with our gold mining ETFs this year is outflows. Now so that to me isn't money leaving the trade and taking profits. It's rather people that were short those ETFs covering their trades. And so the banks have to take money out. It's kind of a technical issue. But we haven't seen a lot of money coming in. And when we do investor polls and client meetings, they barely know that gold has hit all-time highs. So I think a lot of this investor demand has come internationally from foreign central banks, people that are nervous, frankly, about the Trump tariff policy. That's been a big boon to gold. But I think in terms of Americans wanting this in their portfolios, really the risk they would be hedging is our big deficit issues and debt issues, which we haven't talked about yet today. But I think that demand is yet to come. So I think, and it's relatively well behaved. So I think we got a long ways to go.
John, that's a great point here, because we've been talking about, we've seen stories even in mainstream news about the fact that Costco has at one point run out of selling physical gold for many of those investors out there. How do you feel about the idea that the fiscal issues, this kind of safety trade idea against our deficits, against this idea that maybe our country is not as stable as it once was, financially speaking, balance sheet wise, is that a long-term reason why some traders and investors want to be allocated on a percentage basis to precious metals like gold, silver, and platinum?
Yeah, sure. I mean, we like to think of gold as the original alternative asset, and it's obviously been a store of value and wealth for millennia. So it is time tested and proven. And, to us, and we obviously manage tens of billions of dollars of precious metals. Last year was a real unusual year where gold went up over 25%, and we're already at that mark year to date. So what is the signal that gold is flashing going up, well below long-term trend? And it's exactly what you mentioned. People are starting to reallocate to gold, but it is still a very small number of the population. What we've seen the last 3 years is central banks being big buyers of physical gold. This is part of a de-dollarization strategy that China is really driving. This is about diversifying away some of the FX risks in their portfolio and reducing exposure to US dollars and treasuries. The other phenomena that's happening this year that I think investors need to take note of is gold is up about 26% for the year, yet US treasuries are kind of meandering around, and that's not really providing the same safe haven experience or behavior that treasuries and the US dollar have traditionally played during previous periods of uncertainty or risk. And so you have the US dollar down 9%, the DXY index, which is very unusual. And in a financial calamity, because usually King Dollar kind of reigns. But this is part of a larger concern that's growing globally around, obviously, tariffs, trade wars, and deteriorating global relationships. And so whether you're trying to, hedge interest rate risk, default risk, currency risk, equity risk, gold has proven itself to be very effective. And at Sprott, our Sprott Physical Gold Trust, we've seen well over $1 billion of net inflows. So while investors are not allocating to the equities yet in the mining sector to the same degree, we are definitely getting flows in the physical side. And more recently, our silver trust has also brought in about $500 million. So we're starting to see investors gravitating, as you said, to silver and more recently platinum. As gold has become very expensive, you're seeing some rotation and substitution by investors that are looking for better value in those two white metals.
Got to bring up digital gold. Come on, a little Bitcoin, right? So we have a Bitcoin ETF, HODL. Interesting factoid for you. So about another money manager did a study. 37 million Americans own exposure to gold. 37 million. Guess how many own exposure to Bitcoin?
It's got to be a fraction.
No, 50.
No,
yes,
even more.
50 million Americans through their research, and which I thought that makes a lot of sense to me, because I think people look at both as a store of value, and over the last couple of years, a lot of the hot money, because of the appreciation, has gone into Bitcoin. I do also think, though, getting back to my prior theory, gold will have more of its day, right? So that's why I think we're still early, and we're seeing inflows into our gold bullion fund as well. But I think Bitcoin is right near all-time highs. I'm not sure where it is today.
It's about 109, 110,000 right now as things stand right now. All right, so we've covered a lot of ground, from alternatives on the private side of things to gold and silver to uranium and everything else. That does it for this week's ETF Edge. Thank you so much to both Jan and John for their time here today. Now, we've asked John to stick around for the ETF Edge podcast. Remember, you can watch and listen to all of our weekly installments over at etfedge.cnbc.com. Thanks for joining us. We'll see you next week on ETF Edge.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.